Happy Friday, Pat. Welcome, welcome.
Welcome, everybody. How you doing?
Yes, welcome to the Mick Report. This is where McHone McMasters get together and say, what the hell's going on out there? And we have moved our summer live stream to 9:30 in the morning instead of 3 in the afternoon because now with the kiddos out of school, we don't have to worry about sucking up all the bandwidth. And because, for our millions and millions of viewers out there, like right now, 1,000,002. I don't know how the servers can handle it, to be honest with you.
I know.
We had two, but they're gone. I'm looking up at the count there and I go, oh, now they're back. All right. So welcome everybody. Hey, I thought it would be a good thing. We're going to go over a few numbers and look at some things here in this sweltering climate that we have. You know that AccuWeather's predicting hot 120 for Phoenix on Sunday.
Oof, really?
Yeah, woof is right. Jeez.
I didn't see that.
yeah, maybe you don't want to look at that. So
I don't want to look. It's kind of like some things you just don't want to look at.
Most outdoor temperature gauges only go to 120. And I remember when mine peaked out once. I sent a picture to my dad. I go, I got to find one that goes to 125. But I thought, getting back to the topic, we had Barry Habib on, and Barry, was talking about interest rates, talking about how they're tied more to inflation, and that inflation was going to greatly improve. I don't need to answer this. So let's go back and take a look and see, so far, is he way off? Is he accurate? Because nobody's ever 100% on the money correct in the real estate and interest rate predicting world. It's impossible. And especially the big guys like Zillow and Redfin. I always like looking back at the end of the year and seeing who got the closest when it comes to predicting. Yeah. And everybody last year said we were going to have a down year over year. And so far, we're not seeing that. And then the other interesting thing I'm seeing, Pat, right now is that, on Fridays, we usually see an uptick in new listings every Friday.
Yeah.
So we'll go around like 10,000, 10,000, 10,000, and then an additional 500 homes always shows up on Friday as people get ready for the weekend. Get your listing out there before the weekend. I'm not seeing a bump. You can see down there on the bottom ticker there that we have 11,400. And yesterday, I think we only had 11,300. And so we're not seeing that pop up on the weekend. Now, is that because of summer? So I went and looked it up. And here's our average of new listings by month since the year 2020. So you can see that June is 249,000 and July is 236. So we go down a little bit, but not that much. I mean, when you look at the worst months are November and December, we don't get new listings before Christmas. So seasonally, it's not accurate, I guess, to say as well, we're just slow because it's summertime. It's even though we're slow, we still have those daily ebbs and flows that we're just not seeing now. So I thought that was an interesting thing to take a peek at. So we're going to look at Barry. I'm going to pull up one of the comments that he said here, and then I'm going to look at kind of our market, our dashboard, and then let's dive into what you're seeing in the mortgage market. Because if you're a buyer, it's been a pretty decent week, hasn't it?
Somewhat decent. It hasn't been like earth shattering, but it's been on the positive side for sure. On the positive side.
Well, let's take a look at one comment that Barry said here. I'm going to turn this on and see what's going on. Let's take a look at this for a second.
We're not even thinking about hiking rates. And Janet Yellen was out there screaming, we've got to go big on quantitative easing. And why did they make that mistake? Because what they saw was this. They said, hey, you know what? When we look at inflation back in 2021, we're seeing only 1.5% because they were looking at a lagging indicator in rents, which represented 43% of it. In real time, rents were going up at 15%. So the Fed screwed us by looking at this instead of this. And they're doing the same to us again because they continue to look at this lagging indicator. They're being data dependent instead of looking at what's happening in real time. So inflation is going to come down. We're headed for a recession. We're going to see inflation come down. Thank goodness real estate does well. Mortgage rates do well during recessions. So the outlook is good. It's just that right now, as you said in the opening, this is an odd time.
So a couple key points there that I thought we could kind of dissect a little bit. One, that, he was saying that the central banks are always looking in the rearview mirror, and that they're behind the eight ball now, because we're seeing, he was looking at inflation with regards to shelter, correct?
Yes, correct. Yeah.
And he's saying that it's already coming down.
Shelter makes up about 40% of it. I mean, makes up a good percentage of that.
Yeah, and it's coming down. But the other, and he is correct. When the CPI numbers came out this week, they came in considerably lower, except for core. Core was still running at 4.8. Shelter costs are not quite dropping that much. They are coming down a little, but like he said, they look at that in the rearview mirror. So they look at this data that's probably, a couple months old. Have they over tightened? And that's what he's kind of giving the warning for. But he was correct that the inflation numbers would improve. Now, he also was saying that the Fed probably won't have much of a choice but to stay put instead of going up 0.25, because he thought that the inflation number, if it does indeed come down considerably lower, that they'll look silly going up and raising the rates. Yet the bond market and the traders on the surveys, 93% of them are predicting a quarter point move upwards, 0.25. So when do they announce any moves, Pat? Is it the 27th?
It's the 27th, correct? I believe so. Yeah, it's the dates there.
So we'll see if Barry's correct on that one. And like I said, it's fun to go back and look and see what.
Some days I have a tendency to get some of the dates. You look at all these numbers and the dates. It's like, okay, the CPI, the PCE, I have a tendency too. I mean, just in my little world here in Chandler, like you said, I've said this the last couple of years is, I try to do the best job on my side of things of looking at numbers, looking at what people are saying, looking at psychology trends, trying to put a whole. I don't really get stuck too much on one particular number. I don't think anybody should. And not that I'm
real estate's not a daily move either. So,
and it's psychology. I mean, you can look at the numbers, you can look at the numbers and the data, but it's also, like you said, remember, I've always kind of came up with this a couple of years ago. You look at numbers turn into trends, and trends, psychology was numbers, trends, and psychology. And you have to look at, they kind of all roll together. And that's why I'm kind of, the last couple of weeks, I've been kind of looking at what's been going on psychology wise. What are people doing? Are they sitting around or whatever? And I'm looking at how the interest rates are reacting, how people are reacting. And, I'm just trying to get a whole step back and look at it from my perspective.
Well, Pat, Barry had another statement in there where he said that we are going to have a recession, and recessions are good for real estate. What do you think he means when he says that?
Well, they have been. I mean, basically, it's been proved. I mean, it's the numbers. The bottom line is, you look at the past recessions, and real estate has actually gone up. I mean, well, because interest rates go down, and when interest rates, typically loosen up in a recession, you got affordability that's going to, obviously help you. Now we're in this different realm. We've never been here before. You and I talked about this last couple of days. How did we start talking about that? Is that who was bringing up the fact?
Yeah, one of the commentators, I can't remember the article, but said,
Powell,
Jamie Dimon. Jamie Dimon said, we've never had this much quantitative easing, and we've never had this much quantitative tightening. So we don't know, we don't have any history to look back on. So Barry is saying, past recessions haven't been bad for real estate. Now, I would push back a little bit and go, I've been in a couple where they were bad. In California, I lost my shirt on my house out there, but I wouldn't have lost my shirt if I wasn't moving. If I'd have stayed put, my house that eventually got down to where it was only worth $150,000 is probably 900,000 today at a minimum. And so, but at the time, the defense industry, which was really driving the market in California, it was in the 90s, and everything had negative GDP for, I think, 3 quarters. We took a hit. So again, it depends on the length of the recession. And I know a lot of viewers are saying, well, when a recession hits, people lose their jobs, they're forced to sell their houses. Not really. Not all the time. I don't, we can have a recession where we have 2 quarters consecutively down 1.5%. You probably didn't even feel it. Yeah. And so the central bank will look at that, to Barry's point, and go, well, we've pulled back a little too far here. We better bring rates back a tick. And there's a lot more reasons that they adjust rates for just real estate. They have to be careful now because of what's happening to small regional banks. And more importantly, the interest on our national debt is spiking, and it's getting at very dangerous levels. That puts a squeeze on all credit. It also puts a squeeze on commercial lending. And what we're seeing now is, and we didn't ask Barry about this, I think we did ask him, will there be a connection between commercial real estate and residential? And he said no. But there might be, in that right now, a lot of banks have been told not to lend to small businesses because they need to shore up their books, hang on to their reserves because of what they think is coming down the road with commercial loans.
Yeah.
In other words, save your money because we think there's a storm coming. And that's bad for small businesses. Now they can't expand, they can't borrow to stay solvent, and you gotta wonder how lending is going in some of the farming areas like North Dakota and South Dakota, where farmers every year go in and say, I need this much money for equipment and seed. And then they go out and then they grow the crops and then they pay off the loan. So those are the things that get hit if we end up with a credit squeeze. And a credit squeeze will come if rates stay high and all of our money, it's not the Fed's money, it's yours and it's mine, goes towards paying debt. It's like a credit card, right? Yep. You make the minimum monthly payment. You're not paying down principal.
No,
you're just paying the interest. And that's what's happening with our national debt. We're not paying down principal. We're just barely keeping up with our minimum payment. And so that's a number to watch. And that'll only get worse if we end up in recessionary times. And then the tax revenue starts going down. Will that crash housing? I mean, we don't have any historical data to look at right now with what's going on. We can look at where we're at today and see that this is our active listings kind of going up and down like a yo-yo here the past 30 days, but it's trending down. We can look at inventory, and inventory, same thing. It's going down. And the under contract is kind of coming up slightly. Nothing major, but it's still below where the trend has been. And this is, and here's canceled listings, people giving up. Not that many. What I am seeing though, Pat, is that contingencies are down about 100 homes. That it's harder to get a contingency accepted now than it was a while back. Days on market, sitting here looking, actually we're going up. Now they're coming down. So there's nothing really earth shattering there. It gets back to what you say. Well, we're just kind of stumbling along. And then some of the numbers that we saw here in the CMI report showing a few more red here, except for Chandler, Mesa, Paradise Valley, and Scottsdale. But Chandler still got a CMI of 331. That's very good for sellers. And we're seeing that down there, especially Chandler and Gilbert. Gilbert slid a little bit. They're down to 212. So they're down 7%. So we're muddling, and you're seeing that in rates too, right?
Yeah, pretty much. I mean, today we're having some pullback. I mean, we had a run up. These are prices. So this is obviously this run up is these are prices. So it's a positive. You could just see how the market. Did you see how it changed from 42 down to minus 28? If you saw that or not?
No, I didn't.
It was down 42. Now it's down only 28. We're just seeing some pullback some technical pullback today. The 10-year Treasury's at 3.81. We had a nice run up. I mean, from 98, the bottom was 98 or 97.98. Let's call it 98, up to 100. So we had about 200 basis point run up in bond prices, mortgage bond prices, MBS security prices, the last week or so. So there's bound to see some technical pullbacks here against these resistance levels here on the rates. So I mean, but like you said, once again, if you pull back, going back 1 year, I still feel like we're stuck in this channel. And I was watching. I don't know, can I mention his name? The other podcast or California?
Sure,
Jeff Smith.
why not?
Yeah. Jeff Smith. They do a good job over
Love
in
that guy.
California.
Yeah.
Jeb and Josh Lewis, they do a great job over there. And he kind of can, I saw him mentioning about the fact that, kind of what we talked about, that they see this market muddling along a little. There's nothing that's crazy out that stands out that's going to be like, this is what's building. Yeah, there's some banking issues, but I think that's going to be somewhat. We've already seen that event happen. So I think if it happens again, it's going to be like, okay, here's another one. It's not going to be, I don't think, is the shock to the system.
Yeah, we haven't seen anything come in and shock the system since they had the first abrupt rate increase. Everything seems to have adjusted after that. I mean, the real estate market started going way down. People were shocked. And then now it's like, okay, well, and then, we've already seen that movie. Gary has a question here, Pat. I don't know if you can answer this. Can you speak to the jumbo spread tightening?
Honestly, I really can't. I really can't have anything intelligent to say about that, to be honest with you. The jumbo market, I mean, I really, lately, as a broker, the banks themselves have kind of a, I wouldn't say monopoly on jumbo pricing, but they typically a bank like Wells Fargo, Community Bank, they'll price pretty aggressively on the, or like, Merrill Lynch, these bankers, they'll price very aggressively on jumbo because they basically can go after these people in terms of capture their assets too. There's
a lot of chatter on treasury spreads there where, they say this is predicting a recession, and if the spread is bigger, then it's predicting a harder recession. So let me ask the people watching: do you think, Barry says we're going to have a recession? What does recession mean to you? And do you think it's going to be a hard one, or do you think it's going to be one that we barely notice?
Yeah.
I think going to barely notice it.
I think so. I mean, I don't know. I mean, I just, like I said, I wish I could speak to jumbo spread. I mean, it's a different market out there in terms of jumbo and the regular conventional. I haven't really been playing in that market the last couple of years because, like you said, it's the banks have been really more competitive in that area. But
you spoke earlier that, and we even touched on it a little bit yesterday. We are always expecting something to change next month or in the next 6 months, but it looks like we're kind of moving in 6-month increments.
6 to 8, 12-month increments. It's like, we've been muddling. How long have we been muddling along since what? About, you figure what? December, January? I mean, we started improving in January as far as sales, but if it just comes to rates have stayed in that narrow range. You can see it here in your chart. It's staying right in a flat line. It's kind of like 6.5, 7.2 down to 6.5. So it's not making any major breakouts. And so, we could, as people are discussing real estate and everything, there's really two camps. One, the Fed's going to keep raising things till they break something. That's a very popular scenario. So we're watching that, waiting for something to break. It's going to show up in the numbers if that happens. I mean, that's one of the things I look at when I track the 7-day moving average here. And that is, this is a holiday dip, right? 4th of July. And then you wait for it to come up and you say, well, is it going to rebound back to where it was? Well, probably not, because it's summer. And if you've ever tried to open a lockbox when it's 115 degrees,
You know what a party that is. But new listings barely going up. New contracts rose almost back to their current level, but now they're trailing off. They're staying about 2,700. So these are the numbers that if there's a breakout and if there's something really changing in real estate, you'll see it right here. This is a daily tracking. So you can, I mean, if rates were to go to 8% tomorrow, this yellow line would fall. And that yellow line is nothing more than somebody saying, yeah, I'm going to write a contract. I'm going to buy that house. So that'll show up. New listings, though, if rates go to 8%, are not going to flood the market because there's no reason to. So we're kind of stuck. And my feeling looking all the way up to Christmas time is this is where we're going to be.
Yeah.
We're going to be right where we're at today. Beyond that, I don't know. But I think based on what I'm seeing right now, that, get used to it.
Well, that's the thing. I think, to take one extreme or another, say the market's going to crash or it's going to do this. I mean, it just feels like we're just kind of like down this middle. We're hugging the yellow line and just going right down the road. And, like I said, looking at the psychology of it, people are just kind of sitting on the sidelines. Once again, we talked about the other day as far as, I think you have to consider if you're looking at buying a house, you have to kind of throw out all the news, see where you're like you gave some good advice the other day with Jackie as far as just get your ducks in a row. I think we're going to be here. I just don't see anything on the horizon. This has been we're beating a dead horse, obviously, the last several months, but I just don't see a major crash. I mean, there's a difference between like Josh Lewis on the podcast the other day. Last time I was watching. People are waiting for a crash, but could there be a correction? Yeah, we saw the correction, in the last year where things kind of pulled off a little bit. But I think the biggest push that's going to help people is interest rates. And if interest rates do go down, low to mid fives, Morningstar had predicted by 2025 that rates were going to be back in the fours. That's a year and a half out. But if we see rates do lower, I mean, that's the best way to increase affordability in the short term.
Well, Al here's saying that, rent prices in Arizona seems to be softening. They are. And that's because there's more permits for multifamily housing than there is for single family housing. In fact, there's a new deal coming here that it's a trend that's still out there, and that is these build to rent communities. Build to rent project goes ahead near the Taiwan chip plant, plus 7 more deals to know. But they're going to build 354 units at Bronco Trail in North Phoenix. These build to rent homes, they're not cheap. I mean, they're starting 2,200, 2,500, but they're little 2-bedroom places. Some of them are 3-bedroom, and they're a little community, and that appeals to some people, if they can't buy, but they still want to get out of that. The appeal to that is you don't have an upstairs neighbor. You're not renting from an apartment, and you still have a clubhouse. You still have a pool, and your neighbors are right across the street from you, but you can't hear their stereo. You can't hear their footsteps. So that's the clientele that loves that type of unit to rent, and they're finding success with it in Arizona. They're building more and more of them. So as more of them come up, that softens rent. But rent's down 4%. Sounds great, but it was up 20% last year. So it's yay, we're only up 16%, but it's you're still writing that check and it still bites. So I think
I'm glad you kind of explained, because I always kind of in the back of my mind I always wondered, build to rent. It's like what is the appeal there? But you kind of explained that for me. I want to touch base on what Barry brought up this morning. I'm just looking at these notes that he said, because he obviously in his morning updates, he said one of the Fed governors, Chris Waller, is a voting member, wants to hike 2 more times as he believes the strength in the labor market gives them reason to tighten further. He says he believes that the Fed pauses hiking, waiting for the legs to arrive. It may be too late and inflation might move higher again. But he said that, I love how Barry kind of goes against. He kind of slaps these Fed governors around. He goes, in response to the most recent cooling inflation data, he said that one data point doesn't make a trend. And Barry says, we would argue that inflation has made a huge improvement, dropping each month over the last 12 and falling from 9.1 to 3%. And he said also, he goes, the Fed president, James Bullard, he's been a bull. I mean, he's been hawkish. He's not one that votes, I guess. He's the one that said that he wants to see hike over 7%. He's actually stepping down, and he's leaving the Fed to take over a Purdue Business School as a dean. So they've got a new Fed chairman coming, or Fed member coming in, Kathleen Pease. So they're going to see how that plays out with, obviously what her comments are. But he said, to go back to your point about recession, unemployment, this David Rosenberg, who they follow, he had pointed out that California is already in a recession. Their unemployment rates moved higher by 0.7% from a low of 3.8 to 4.5. And he said, historically, 100% of the time that this has happened, a recession was in the cards. And he said that California is a good indicator for the rest of the country that the recession is coming. So he kind of made some notes about that today in today's morning update.
Well, you don't know you're in a recession until you look at it in the rearview mirror. I mean, because the numbers are lagging. So, you go, a recession is 2 quarters of negative growth. Well, when are you going to know that? After you've been through 2 quarters, 26 weeks. So you're not going to know it today. We might be in one now, although it doesn't look like it. Not with some of the short-term numbers we're seeing. But here's, to your point on inflation here, here's inflation continues cooling down in the U.S. Here it is from 1970, 1980. They're right there, 14.6. That's when I bought my first house. And then we had, obviously, 2008 brought everything crashing down and, major recession. But that was major. So here's getting back to 1990, where I told you I went through a recession. There's inflation there, came down, was sitting at 6.4% and went down to 3%. So where's this 2% target that they talk about? We've hardly ever been there. We were there in 98. We were there in 2002, 2006. Then we got negative inflation back here in 2015 and 0.03 in 2020. This is around the point where Barry was just saying, we don't have any inflation, and we don't see any inflation, and we don't see raising rates. We don't plan on raising rates now or ever. Remember those statements that were coming out?
Yeah.
And so this spike surprised them, and it shouldn't have, because we flooded the market with trillions and trillions of dollars. And Jamie Dimon said yesterday, there's still $1 trillion out there that consumers have. And he said, that's probably going to be eaten away by the end of the year. And he said, and we could face a mild recession. So there's still money out there. Well, that money's still out there, and our inflation's at 3%. I think Barry's correct. I think inflation is already coming down, but the money's still out there, but it's starting to dry up. That will have an effect on inflation, but it won't take too much to reignite it, though, especially with shelter costs. If they come in and lower interest rates to 5.5, if the bond market is starting to accommodate, that's going to ignite housing again. And I don't think that's good for any of us. So
I hope looking back,
we're in the industry and we want it to pick up, right? Because it's just slower than heck right now, but it's not healthy.
It's been just a very segmented market out there. Like you said, it feels, like you said, I'm just starting to putting everything together. People are just sitting there waiting for rates to drop. Once again, that survey really caught my eye when he said 70% of people are waiting for 5.5% before they buy. And it just seems like everybody's waiting for that. And
well, that's a huge number, 70% sitting out there, like you said, in safari mode with their binoculars, look at the market. 70% of potential buyers are waiting. When they hit that number, that's just a run for the hills. I mean, like, let's go buy now. But then you wonder, if as rates are coming down and they get down to 5.5, how many people are going to sit back and go, well, it might go lower. I'm going to hold out for 4.
Oh yeah, that's what you got. You saw that when rates were at two and three quarters, 3%. There I saw on some Facebook posts that people were like, well, rates were at 2.5, 2 5/8. I was looking at some of my past refis on my database, 2.5, 2.625. And you had people out there waiting, oh, I'm gonna wait till 2%. Well, that
Yeah,
this
well, I had
wasn't
a comment on our channel, Pat. Somebody said, I have a 2.75 rate. When do you think I'll get to refinance to a lower rate? And I said, not in
never.
your lifetime.
I,
That's it. That was a rare moment in time. I mean, we won't see that. I mean, we went down to 2.75 because the central bank was trying to keep our economy going because everything was shut down. So it's going to take something at that scale again to see that much money getting injected into the system, and they don't have room for it now. They can't.
no,
They don't have. They just can't do it. I mean, it's like you have this bank account there that you've saved your money for reserves for bad times, and you've already spent it now, and so we're out of money, and the Treasury's out of money. The central bank, yeah, they can inject whenever they want, and if things get really bad, they can probably pull the trigger again. But I don't see it happening. I think we could, not to get too wonky, but we could end up with some kind of a washout. I think I've said often the debt bomb is ticking. I just don't know how long the fuse is. And
yeah,
so I watch a lot of that stuff and it's interesting to follow, but it seems like most of my adult life, I've been warned about the debt situation. And
yeah.
here it comes. It's going to get bad. Gold's going to go up. Everything's going to be nuts. Banks are going to close. Well, I haven't seen that yet. And, I'm running out of time here.
No, I
Not
just think,
anything soon. Yeah.
like you said, I think we talked about it last, a couple of days ago. I mean, people that are looking to are seriously buy. I mean, I'm kind of coming out of the camp that just things are not going to change that much. I mean, if rates, it just seems as though low to mid sevens has really been the tipping point here recently. We see a pullback. Every time we see 7.25, 7.375, we go back into the high sixes. We're just stuck in this range, and I think people just have to. If you are looking to buy a home, I think it's not going to be easy. The low hanging fruit's gone, but yeah, I think you have to spend more time not trying to time the market, but just try to find that home that you like, try to fit into it, budget wise. People have to change their frame of mind, their psychology, I think, a little bit.
Well, when rates got up to 7.25, the conversations quickly shifted to here comes 8%.
Yeah,
Goes back to when rates were 2.75. People are like, when do you think it's going to go lower? It's hard for the group to recognize that moment, we're at 7.2. Mentally, you're going, well, here we go. It's going to keep climbing. Well, now we're down to 6 point, what are we at? 6.87. And
6 to 7 8.
so now you're saying, okay, well, are we on our way to the fives, or are we going to get down to 6.5? Very few people go, oh, good, 6.87. Let's start here. So the entire market is waiting for something. And we're looking at a rate chart that just muddles along right now. We're looking at economic data that might signal a recession. So here we wait. So getting into December, I think this is it. If you're thinking that we're going to have considerably lower prices going into the final quarter of the year, I don't think so. I'm going to look up where our median sales price is right here for now and show you, because it's interesting. There's a little bit of a downturn, nothing major, but you can see a little dippity do there. Kind of surprising. That's where we're at today, but nothing major. Now, if you were to look at our long-term trend, if we were just to go this way, this is our breakout when things got crazy, right? And a lot of people are hoping that we get down to 2019 levels. Well, that's right here, what they call pre-pandemic. Are we going to get there? It's looking highly unlikely. You would need a major economic catastrophe for that to happen. And with the amount of people sitting on low rate mortgages right now, they're only going to sell if they absolutely positively have to. And where are they going to go? So who knows?
I'm going to be a betting man to jump in and say that if something like that, based on my experience the last 36 years, if you have something that shockingly happened to you, nobody's still going to do something. People are gonna be like, whoa, oh, I'm out. I'm out. You know, it's just I'm not touching this right now. I mean, we
Yeah.
saw that in 2000. The psychology of humans is pretty interesting. But like you said, if you saw that, what do you think the chances are that you'd be, am I right in that thinking? I mean, I feel that way.
Well, let's just look at the stock market, for example. When the stocks start going down, very few people look at that as an indication that maybe they need to move out of equities into some safer products, right? They're hoping. And by the time their stock gets battered, now they sit back and go, well, it doesn't make any sense to move it now. I've already got the crap kicked out of me. I guess I'll just wait till it goes up. When the tea leaves were there saying, well, it's the Fed's starting to tighten, not a good time to be in stocks, but people hang on to it. So again, that's an example of looking in the rearview mirror. Oh my God, my stocks, I got hammered. Well, there's nothing I can do. Oh, house prices went down. There's nothing I can do. It's hard to spot those indicators of trouble brewing, and that's what a lot of people are trying to do. Rightly so.
Oh yeah,
I mean, if you're
I give them
$1.5
gas.
million,
I don't blame them. I don't blame them.
Yeah, you got to look for indicators, and that's the hard part in this market right now. There's very few long-term indicators out there for us because, again, we've never been here before. So is there anything coming next week that could possibly move the markets for you?
No, nothing. I mean, we've got retail sales Monday or Tuesday, mortgage apps. I mean, nothing crazy. Initial job claims, initial jobless claims on Thursday. Nothing. There's nothing earth shattering that's coming out. So we're just gonna probably be muddling along here a little bit further next week.
Okay, well, next week for me on travel, it may be a little sparse. I'm going to be going to Canada on Tuesday, and then I'm going to be out at the Pacific Ocean. I believe it's Wednesday and Thursday. I should have a good signal out there, and we should be able to do the Thursday show. Friday, not looking good.
Okay.
I looked at my camping spot, and it's all trees. And Starlink satellite does not like trees. So I'd have to raise that pole up about 100 feet to get a signal. So Friday, Saturday, I'm out. So
why don't you rent a boom, raise yourself up about 200 feet above the trees, and get everybody talking. What the hell is that guy doing up in that boom with a computer?
Yeah, I've got a good friend that owns a lot of equipment out here, so we'll see what he can do to help me.
Yeah.
In the meantime, Pat, have a great weekend and try to stay cool. Hunker down and have fun.
All right. Thanks, everybody.
See ya.
Bye.